India's third quarter GDP growth came in as expected at 6.2%. But what was heartwarming about the Friday data is that the previous 2 years' GDP, FY23 and FY24, have been revised sharply higher. FY23 has gone up from 7.2 to 7.6 and FY24 from 8.2 to 9.2. What is more important for us, the forecast for the current year GDP has also been revised higher, albeit slightly, by the NSO to 6.5% from 6.4 earlier. Well, the important point is we are nowhere near the sub 6%, which was announced for the second quarter GDP. Remember, it was 5.4, now up to 5.6. So, has the economy turned the corner? Can we see some GDP upgrades as we go forward? To answer these questions and, more importantly, to usher in the International Women's Year Week, I have with me two women economists, Sonal Varma of Nomura and Madhavi Arora of Emkay. I mean, they are top-rung economists anyways, but I'm just adding on the women's tag because it happens to be that kind of a week. So, ladies, thank you very much indeed for joining me. Madhavi, I'm going to start with you simply because you're sounding a little more positive than Sonal when I read your reports. That's my question to you, really. You know, aren't there in the internals something to draw positives, that there is a chance for upgrades? You know, agriculture 5.6, trade, hotels, transport 6.7%, construction 7.2. All these are employment-heavy sectors. If these are pushing up growth, isn't there a chance that we're going to get better numbers?
One has to realize the fact that, as the last 2 years have been revised up, the current year's slowdown is looking much more massive than otherwise. You know, you're looking from a 9.5% to now a growth which is more rangy around 6.5%. But that said, the sharp upgrades that you have seen in FY23 and 24 period also probably increase the probability of upward revisions in the current year data as well. As of now, we are still using the high frequency data for the current year, while FY23 and 24 have been revised using ASI and annual NCA data. So, one has to realize that when we entered FY25 first half, the second half of FY24 actually was running close to 9%. So we had a much better momentum, which probably could have spilled into FY25 early as well.
Quarter.
So there could be a possibility that we may see upgrades, but that will again happen with a lag of a year. By then we would have moved on and probably, focus more on FY26 and 27. But that said, there could be a possibility there could be strong upgrades in FY25. That said, if we just focus on this year's data, looking at the quarterly numbers, I think there's more to worry than to be very optimistic about things as of now.
Oh, okay. So you're singing the same tune as Sonal, actually. Sonal, I want to anyway try with you. You are saying that growth recovers, but it is still cycling down. That's the word I think used, Sonal, in your report. I'm just trying to play the devil's advocate. Is it not that with employment-heavy sectors like trade and construction and agriculture doing well, that consumption can get a bump up? And then let us remember there is also the tax break that's coming. So can't consumption give you a pleasant surprise?
Latha, I think when we try to look at growth and analyze growth, we need to segregate the cyclical sectors and the non-cyclical sectors. What we've clearly seen in the third quarter is a much better momentum. And if you look at the components that have driven it, I would say to a large extent are sectors that are not as cyclical. So government spending has picked up after the election and code of conduct and heavy monsoon-related slowdown. Rural demand has picked up because agriculture output is better, and some of these factors will be here with us. Now, the other side of the equation, are the more cyclical sectors that are more private sector driven. So urban consumption, which is driven more by things like availability of credit, salary increases, stock market wealth effect, private investment, which has slowed down despite the pickup in government consumption, and exports of services have picked up. But it's really been a big contraction in import, which is a signal of domestic demand that led to a big net export contribution to GDP growth in the third quarter. So I think it's in that context that, Q3 has been better, but the components that are driving that, don't give the confidence yet that we are on a durable recovery path yet.
Okay. Would Q4 be better than Q3? What's your number, Sonal?
Yeah, we are looking at around 6.5%. I mean, the second advance estimate implies a 7.6% for Q4, which at this stage looks too high to us.
Okay. Yes, that's what many people told me. But Madhavi, I want to persist with that point also. The CA made some very relevant points. Maybe you can still accuse him of stretching his optimism, but nevertheless, the Mahakumbh is much bigger than anyone earlier forecast. That will mean at least one-shot GDP growth. It's not persistent, but at least a one-time. And then there is the services exports have done extremely well. And then you have, some momentum coming in from the rate cuts and liquidity boost given by the Reserve Bank. Can't we make it to 7% in Q4? Is that out of line?
So, Latha, a large part of the, Q4 GDP print is essentially coming from the surging net indirect taxes effect, which is what we saw last year as well, right? The GDP is looking much more realistic, though we think there could be a downside risk there as well. But GDP is largely driven by the difference between GDP and GVA is massive, which is largely driven by the fact that there could be an estimated net indirect taxes growth of more than 15%. January data so far also has shown that the subsidies for the center has actually been 20% lower than last year because they were largely front-loaded in this financial year. So there could be a possibility that there would be a big wedge between GDP and GVA. So we'll have to remove that noise as well. GVA is expected to grow much less dramatically to around 6.2% in the fourth quarter, 6.8% in the fourth quarter. There could be as I said, modest downside risk there as well because we had seen large part of this 4-5 months growth essentially led by government spending, which could possibly slow in the fourth quarter. But you will have the one-off effects of Mahakumbh festival, as well as probably agriculture growth, which is also envisaged to grow above 6%. And again, that will not have a spillover effect on following quarters. So I don't think this temporary boost to GDP should be seen as a strong indicator to the underlying growth or a spillover effect that could be seen in the following quarters. So I think it would be unfair to assume that just because we'll see a massive growth, possibly a higher than around 7% for that matter. But I'm not sure whether that could be seen as a permanent boost to growth. It's just a temporary surge that you will see.
Okay, I don't know why you're skeptical about government spend because now we have the January capex that is 50% higher than.
I'm going by the budget estimate, so I'm just doing the
I agree. I agree. Yeah, so even, of course, to be fair, even last quarter, October, November, December, the total spend is 50% more than the previous year-ago quarter, but gross fixed capital formation is only 5.7%. So, it's a small part of the overall capex. But Sonal, exactly the same thing. Don't you expect the Reserve Bank steps, liquidity steps, and government capex really coming good now? In December, it was double what it was in year ago December. January, we have the capex numbers. It is 50% more than year ago. Can't all this give more legs to the current quarter itself? Better than 6.5%?
It's possible, Latha, but I think, the current quarter is almost over in 1 month. I think we ought to be focusing on the next 6 to 12 months. Now, just on government spending, actually, the fiscal deficit number for Jan was much higher than anticipated. So while CAPEX is picking up, tax revenue, particularly the corporate tax revenues are quite low. So based on the revised estimate for FY25, actually, the fiscal deficit for the next 2 months ought to be much lower than what it historically has been in the last 2 months, which means that we could see some moderation in capex in the month of March. But I agree with you. I think, the counter-cyclical policy tools are underway in India. It's just that it takes time and it's coming across in the backdrop of this ramp up on trade protectionism that we are seeing. And that has led to some front loading of exports in anticipation of the tariff hike. So the payback effect will actually be seen in FY26. And I think also this on the urban consumption side is something we need to closely monitor, because while the macroprudential norms are being eased, delinquencies are also picking up in the unsecured segment. So to what extent banks would want to lend to these segments is not very clear as of now. Plus, as I mentioned, stock markets, there is a wealth effect that will be spilling back into the urban consumption side. So we have to look at overall how things play out. It's possible Q4 is much better than expected. Policy easing is happening, but in a backdrop which still looks a bit hostile to us. So it is in that backdrop. Currently, we don't see a sustainable recovery as defined by 6 to 12 months of sustained uptick in place.
And so your FY26 is only 6%, Sonal, right?
Yes, we are expecting 6% next financial year.
Okay. Madhavi, what are the chances of next year surprising on the upside? See, after all, our exports to the US is 2% of our GDP. Yeah. The actual extraction in terms of value add for us, some people are calculating is 0.1 to 0.3% of our GDP. So can the global headwind is bad, but can it be, since we are a domestic facing economy, can we still do better next year?
Latha, for that, we need to have a much more counter-cyclical policy effort, which is not being seen as of now. If you look at the Reserve Bank's balance sheet, that has grown less than 1%, while they are doing all the liquidity measures that they can in the recent months or so. One has to realize they're just paying for their past sins, because between October to December, they intervened up to $100 billion worth of FX intervention, of which the large part of liquidity suction that has happened is because of that. And this is what they are basically sterilizing. At this point in time, the balance sheet is still grown less than 1%. Reserve money is still sluggish. Credit offtake is obviously impacted because of that. So monetary conditions are still tight despite supportive measures that RBI has taken. I mean, if you look at the outstanding value of CDs at this point in time are very high. So RBI needs to sort of be much more easier on its stance. We can possibly see further cuts coming from the Reserve Bank, but we're not very sure as to how deep that would be. On the other hand, fiscal is still at this point in time is, I believe, pro-cyclical. While we have seen some support to the urban segment, urban middle class led by the tax cuts, they've clearly have been cutting the revenue expenditure, ex-interest payment subsidies, which is going to impact the rural segment, which has just started to recover. On the other hand, the urban segment, the wages have been pretty sideways and actually are low on the real basis, which is going to impact the urban consumption. Income effect would be much more felt than the wealth effect that people are talking about. I think to that extent, my absence of the private economic agents is going to be probably the story which will play out even next year as well. And that's why we believe that even though the external headwinds are something which are not in our hands, the domestic dynamics are also not very solid. And at best, you're going to be growing at around 6.5%, which is what we're probably growing in this year as well. So there's very little impulse that I am seeing in terms of growth.
Okay. Point taken. We have to come to terms perhaps with the 6.5% growth. And the big point is we should not come to terms at a policy level with 6.5%. We need much more in terms of policy redesign. Those discussions on a later day. Thank you very much for joining me, Madhavi and Sonal, and ushering in our International Women's Day celebrations with some gusto. Wrap up on Bazaar. On that note, Chartbusters coming.